Okay, so Adam, it's a pleasure to meet you again. I attended your seminar a few days ago, which was fantastic. Now, I love your approach to investing, which is very much risk-based. And so you just look after the risk and the return looks after itself, is that right?
I think that's very much a good way to think about it, and thanks for coming and visiting us today. We've always got this belief, and I think it's a long-held belief, that risk and return are ultimately related. You know, it's kind of obvious if you've got cash, very low risk, and you're ultimately not going to get a high return. If you're investing in individual stocks or even in broad market indices, a lot of risk there, and ultimately the long-term return is higher. But what ultimately a lot of people don't know is that over the short term that relationship breaks down because risk isn't constant. Mm-hmm. The stock market is very risky over the long term and you get the return from that, but over short periods it can go through periods of low risk and go through periods of high risk, and the return dynamics against that are very different, and it's quite complicated actually. And we're trying to take that complexity away from the clients, and we're trying to manage that complexity with a big use of technology ultimately to try and give access to a lot of people to institutional techniques of investing, the type of investment techniques that the investment banks are providing to their institutional clients, powered by their mainframe computers, and put that in the hands of everyone.
Okay, so I think it's nice that you're democratizing wealth management in a way. And you're doing it at a very low fee. So I think your fees are 25 basis points, so that's 0.25% every year for the ETFs, which you actually buy and sell on behalf of your client. And 0.75% for you.
That's correct, yeah.
So all in all, it's about 1% per year, which is a very reasonable fee. And I think you say that the average for a wealth manager would be about 1.3%, is that right?
Oh, even higher. And these are just the headline numbers as well. Yeah. What I think is really important to take note is that when you do invest with a traditional wealth manager, there can be a lot of hidden fees. So what I like to tell our clients is there's really just 1% between the client and the assets that are ultimately driving the return that they should be getting. Whereas when you're investing with a traditional provider, it's not necessarily the case, because you might see a headline fee of 1.5%, but then underneath that is maybe a trading fee or a custody fee or an exit fee or an entry fee. So we want to try and make it as simple as possible. You know the fee up front, you know what you're paying, and you know exactly what you're paying for.
And it's so cool. I didn't realize, because when I actually signed up, because I've signed up for your service, when you actually trade, you trade on behalf of the client. So literally you can see the individual trades in your account generated by your algorithms.
Yeah, exactly. We show everything. We want to be as transparent as possible. So when you log into the cockpit, you can see every single trade, you can see the prices that we paid, we can see the changes that are going on. You click on another screen, you can see to the pounds and pence what type of fees you've been paying us. Mm-hmm. That level of transparency you don't get with the traditional industry.
And honesty too, because it's often slightly misleading if you don't know what fees you're paying.
Yeah, completely. And so when people log into our platform, there's actually not a lot they can do. They can see everything, but all they can really do is add more money, take money out, change their risk category if they would like to, although we don't recommend it because it's typically bad behavior if they're doing such things. But everything else is just a read-only window into everything that we're doing on their behalf.
Now I see that you've just crossed the 200 million euro threshold. You just tweeted it.
Yeah. And
you're gaining money at an alarming rate. So how's that going?
Yeah, we're really excited. So we crossed 100 million euros in December of last year. And now it's the last day in March of 2017. We just crossed 200 million euros. So the rate of growth at the moment has been accelerating. It's been a function of us becoming more well-known, but also a function of people adding more money into their accounts. So when we look at the clients who joined us a year ago, they've more than doubled their initial investments, and they're also telling their friends about it. And this is exactly what we wanted to do when we started the business a little over a year ago, when we started managing client money. We wanted to provide regular people with quality access to long-term investment propositions, and they really didn't have access to that before.
So tell me about your mother. Because I think one of the lovely things you said in the seminar was that you wanted to create something that you could sell to your family.
Yeah, of course. So my background, similar background to yourself, working for an investment bank within a trading role, and because of that, friends and family would always ask me, what should I do with my money? I'm the expert apparently, and I honestly didn't have anywhere good to send them. I felt like I could send them to a DIY house, and if I was to do that, it would very much be a kind of a buyer beware proposition for them, and I didn't feel like they knew enough to be able to do that. And they couldn't access wealth managers' IFAs because they didn't have the several hundreds of thousands that you need to get access to an IFA. And not necessarily needed one either, because they had quite a simple financial position. Maybe they need to use their ISA, they need to stay invested for the long term, but they don't have a complex tax situation to deal with. So I was trying to create that service for everyone so that you didn't have to send them to a DIY proposition. We like to say that, we created a service that even our mums use, and that's the service we wanted to create. Something that I'm happy to provide a service to people that I trust the most and they trust me the most. And if you have that philosophy at your heart, then I think you're always going to be moving in the right direction.
Okay, so in the video I did of my onboarding, I used the word robo-fund.
Yeah.
Now you don't like that.
Yeah.
So you'll see in the actual blog, I've changed it to robo-investment.
Oh, very interesting.
Very good. So perhaps you'd like to explain the difference between the two and why that nuanced definition matters.
Sure. So I don't like the word fund because a fund is ultimately a financial product.
Yeah.
But we're not selling a product here, we're really selling a service. And a fund is basically makes it feel like you and every other client are in the same vehicle. You're being treated in exactly the same way.
So maybe it's good to explain how a fund works. So you have hundreds, thousands of people that pool their capital together. Then there's a fund manager and they buy and sell assets on their behalf. And everybody gains or loses the same amount according to the value of those assets.
Exactly. And the way that we manage money is slightly different. But the main difference is that every client has their money managed individually. So there's no actual fund vehicle around the whole thing. So you and I could be in the same risk category in our service. So we could be in our medium risk category, which we define slightly differently. But I don't want to go into the detail in this answer. And we could have joined on different days and therefore might have slightly different portfolios, because we want to make sure that the mix of assets you have is exactly the right mix of assets for the day that you joined, and that you don't move into my portfolio and pay extra costs when you don't need to.
Okay.
So by treating clients as individuals, it allows you to make sure that they always have the best mix, but it also gives you so much more flexibility going forward. By providing a personalized service, you could think about, all of a sudden taking things into account like tax, maximizing ISA allowances, making use of your pension. All of this stuff wouldn't be possible if you just had a fund. So that's, I think, what you see today when you use a robo-investor, and I don't like the term robo either. The reason I don't like robo is because I feel like it's dumbing down what we're doing.
Yeah.
We're using technology to really create a more sophisticated offering for your average investor. And robo makes it sound like it's actually not that sophisticated. But if you think about where we are now, and what we offer now, and what's going to be offered 5 years from now or 10 years from now, the future looks very interesting in terms of being able to provide contextual, intelligent communications, being able to nudge our clients in the right way so they behave well in terms of their long-term investment goals. You couldn't do that 5 or 10 years ago. You can't do it yet in the way that we want to do it, but with advances in computational power, in things like machine learning and artificial intelligence, there's a lot of interesting things that we could do down the line.
That's really fascinating. So each of the clients that you have is treated differently, and the way you approach things is also very different from other robo investing platforms. Okay, I had to think about that. So let's just think about what's going to happen if your fund goes wrong. So your approach is to say, okay, well, volatility, which is how much markets fluctuate on a daily or weekly or a monthly basis, that's sticky. So when volatility is high, it usually stays high. When vol's low, it stays low. We have these regimes which last a long time. So although you can't forecast returns, you can forecast volatility fairly well.
Exactly.
And you make use of that in your modelling.
Yeah, that's exactly right. So what we do is we know that everybody has an individual risk tolerance. I might be able to stomach a 30% loss, and you might only be able to stomach a 10% loss in your portfolio before you get very nervous and you pull all of your money out.
Yeah.
And what we know is that when people do that, they stay out for too long. They stay out of the markets for years even. And by doing that, they actually underperform because they protect themselves from some of the fall, but they also miss out on a lot of the rebound. So by taking this observation that we have, which is that when risk changes, when volatility increases, we know that in the future it's going to remain higher, we can take action. So we run a lot of simulations on asset classes and look at this risk. And whenever we see that risk is going up, we make adjustments to the client's portfolios to keep in line with their individual risk tolerance. So when you say, look, I actually can't stomach a loss of more than 10%, we make sure that we're making adjustments to your portfolio so that the assets that we have in most of the cases, so what we would call kind of in the good scenarios and the average scenarios, not in a bad year, never breach that risk tolerance. We never guarantee anything because ultimately everything can go to zero in the publicly traded markets. Yeah. But we do have an indication of, in the best 95% of cases or in the worst 5% of cases, what type of loss might be typical, and then we manage to that. So if you say, look, I'm happy to experience a loss of that magnitude in 1 in every 20 years, so in a very bad year, then we can manage to that risk. And we can make adjustments to make sure that you have the best asset mix so you can stay invested and ultimately get that long-term return that you deserve.
I was amazed because when I actually signed up for it, you mentioned the word value at risk. Mm-hmm. Now, this is something I had to deal with for a long time when I was working as a quant in risk management. But I think that must be very difficult to explain to your clients. So, if I was to compare your marketing with something like Nutmeg,
sure,
they've got much more of a kind of Teletubby approach, whereas you're a bit more like Terminator, I'd say. A bit more scary, but potentially...
So everybody always mentions Terminator because I think that he's kind of the evil robot that everybody feels like the machines and the automation that we're going through now is trying to get.
But Arnie was actually a nice guy, right?
He was. I grew up with Short Circuit, right? So the friendliest robot you could imagine. So this is the world that I live in. But yeah, value at risk, it's an institutional risk measurement. It's used at the central banks, it's used at the banks. It has been used incorrectly. So the way, when people hear value at risk, they sometimes think, yeah, but didn't that cause the financial crisis? The thing is, the value at risk didn't cause the financial crisis. The way that people abused the measurement of value at risk was obviously one of the reasons why people underestimated the amount of risk in their portfolios and thus took a lot larger magnitude of losses than they thought they would.
But the concept behind value at risk is a very simple one, isn't it? When you buy any asset or a portfolio of assets, you get this distribution of daily returns. So most of the time it's roughly zero. Sometimes it's very high, very low, and generally it drifts upwards, so it's slightly positive. And that's what you're trying to kind of squeeze out of your portfolios.
Exactly.
And then this value at risk just looks at the bottom tail, looks at that bottom 5% of risk. So you're saying every 10 years I'm willing to lose, say, X% of my portfolio. That's my risk tolerance. So
exactly. And how you then build that distribution, how you model, the potential outcomes, that's where you need to make sure you're making the right assumptions.
And now you use Monte Carlo sampling as well, so let's try and explain that while we're at it. We talked about VAR, why not?
Let's go into the detail.
So I'm a physicist, so the way I always think of things is in terms of quantum mechanics. So
I'm not, so I don't, but let's see where we go.
Let's say I was to throw you something, right? So I take my keys and I kind of throw this to you. It would actually follow something like a parabola.
Yeah.
Because that's the path of least action, they call it in physics. So if we look at quantum mechanics, it would actually follow all possible paths, but the most likely path would be the one that it would follow on the macroscopic scale. So in Monte Carlo sampling, what you're doing is looking at all possible futures. You're simulating thousands of possible futures. It'll cluster around the most likely path of the future, but you also consider even the unlikely possible futures for every asset type. Is that the way you approach it?
Yeah, so we build, let's say, for example, 10,000 different possible paths for each asset class that we invest into. So when we look at the future possibilities for each asset class, you have basically tens of thousands of lines basically going into the future.
I remember that well.
Exactly. And most of them are in the middle, but you're right, a few of them are on the edges as well. They're the outliers. They're the ones which could happen with very low probability, with a very good outcome, but also very low probability to a bad outcome. And obviously it's those bad outcomes that we care the most about, because they're the ones where people get nervous. So then you take those 10,000 paths and you look at the worst 500 of them, and then you draw a line in the sand and you say, what level were 500 of those paths worse than, and the other 9,500 better than? Yeah. And you can mark that line and you say, okay, that is a 20% value at risk portfolio because 500 of the paths were lower than that level and 9,500 were higher. And that's the basis of how we then do our risk modeling and our risk management.
And then the magical thing is, if you actually backtest these kind of approaches where you're just kind of going for the portfolios which avoid those bad outcomes, magically it gives you good returns over the long term. Is that right? You were talking about a study that was recently done.
Yeah, there was a study which came out of Yale University which looked at of controlling this volatility versus a buy and hold strategy, so a passive investment strategy, which is very popular and is better than most other strategies if you were to try and follow an actively managed approach. And what they saw was that by controlling for this downside risk, because risk is predictable, you actually saw better risk-adjusted returns. So you saw for the fluctuations that were happening in the portfolio, you were actually outperforming the buy and hold strategy. And they conducted this study in 19 different OECD markets, and they saw that it was relevant everywhere they looked. And it's because, firstly, risk is predictable, but secondly, when risk gets higher than normal, or lower than normal, you actually don't get the return you deserve in higher than normal periods. You get punished for that risk. It's the same. The good example is the financial crisis. Yeah. In the financial crisis, risk went up, but you weren't rewarded for that risk. You were heavily punished, and this happens time and time again. So if you use this predictability of risk to get out of the markets during these times where risk is inflated, and get back into them when risk is lower than usual, you can take advantage of that feature, this volatility clustering effect in the market, to build a portfolio which potentially will outperform, but more importantly, always in line with your risk tolerance. Yeah. So even if it didn't outperform, hopefully you can stay invested for longer. Whereas in the other one, you might have actually got out because it was too volatile for your own personal risk tolerance. And if you get out, you don't get the return.
Okay, that's a nice way of explaining it. I think I'll finish by asking one last question about what could possibly go wrong. So it's a difficult question, I guess. Sure. So if you are managing for risk and you do depend on this kind of volatility clustering, the kind of thing that could go wrong is when you don't have a warning from volatility, right? So this is like blue sky turbulence, right?
Sure.
So you're in your aeroplane, it's a sunny day, everything's fine, and then suddenly your plane drops 10,000 feet. I mean, it could be a kind of cometary strike on New York or things that you couldn't foresee. Now, nobody can really manage for that, but how would you kind of step into the machine if there is such a crisis? And I think you've done that kind of recently when we saw this very big fall in sterling a few days ago.
So I think that you put it very well. What are the alternatives? If something as drastic as a comet strike on New York was to happen, obviously markets, everything would perform very, very badly, and it would happen instantaneously. And you see this with natural disasters, you see it with terrorist attacks, and what you typically see after those events is that the markets rebound. You don't get any volatility going into the event because nobody knows it's going to happen, but what you see is that you usually recover fairly quickly. After 9/11 we saw exactly the same thing there. That's been one of the worst terrorist attacks on the Western world, and the markets rebound fairly quickly. With business cycle volatility, you do see tremors occurring before the big events. So the financial crisis didn't start with Lehman Brothers. It started over a year earlier with institutions like Bear Stearns and some of the hedge funds that they were managing and some of the mortgage companies in the US. The volatility started way in advance of when the crash really started to occur. And as such, it means that volatility can be managed and can be controlled, and actions can be taken going into that using a data-driven approach. The sterling case falls a little bit more into that bucket, because on the day of the EU referendum result, which was unexpected, it wasn't as if sterling hadn't moved for 3 weeks. The volatility in sterling itself had already started to pick up. So going into that event, we started to reallocate away from some of the asset classes that we started to see more volatility in. So things like EU and UK stocks, we started to move away, and we started to go into US stocks because it looked less volatile. And on the day of the referendum itself, after the result, the only negatively performing asset in GBP was EU stocks. US stocks were up on the day because they were priced in pound, and pound was so low. So by making those switches, we actually had a very, very good experience. So as long as we get some type of control or tremors or indication that risk is increasing going into events, we will be making changes. And versus the alternatives, which may be just keeping things static and hoping everything works out for the best, or moving into cash and getting super nervous, I much prefer our strategy as a way of dynamically using the data that we have right now to make the best changes we possibly can in the portfolio, but in an unemotional way, because emotions are one of the worst things you can have when you're trying to deal with the capital markets.
One of the worst enemies of an investor.
Totally.
Anyway, thank you very much for your time.
Thank you very
It's
much
been a real
for having
pleasure.
me.
Thank you.
Great, thank you for having me.